Yo, what's up, guys? It's your boy Looney, and today we're talking about something people never want to admit, and that is, can you actually make money when a stock is declining? And I'm going to be completely honest here with real examples and real returns. And the truth is, if a stock is consistently dropping, everyone loses, whether you're selling puts, doing some small hedges, owning the shares, maybe even doing some buy calls. Everyone is going to be in the negative, unless, of course, you're shorting or buying puts or doing some kind of bear strategy. But the holders and the bulls of that stock are going to be losing no matter what sort of strategy you use. And I'm going to go over an example with Mara and how I'm handling a declining stock or price that is declining. But before I do, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month, and you get access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links are down in the description. So let's start with the first rule, and that is stock selection. So stock selection matters more than the actual strategy you are using. And if you're investing in weak companies, you're not losing because of volatility. You're losing because the business isn't good. So the only way to make money in a downtrend is if the company itself is strong long term, because strong companies eventually recover, whereas weak companies don't. So let's look at one right here with Beyond. Beyond, if I'm being completely honest, isn't a strong company. I'm not buying this company for its fundamentals. I'm purely doing this as a technical side for the short squeeze momentum. And I am fully prepared for this stock to go to zero or be delisted or to lose my money. And because of that, I'm not going all in. This is less than 1% of my portfolio. I'm not putting all in into a stock that I don't really believe in, if I'm being completely honest. This is just purely a technical short squeeze gamble. And that's why it's very important to make sure you're choosing your stock. Like, this wouldn't be a stock that I'm going to hold long term, if we're being completely honest. But let's assume you do pick a real company with real fundamentals. That's when we can move on to the strategies that actually work when a stock isn't going up. Now, the first thing is dollar cost averaging. That is your first edge. It is the simplest and most underrated strategy. I'm going to use an example on Hood. Hood is a stock that I have been invested into strictly from just dollar cost averaging, buying $2 a day, not a big amount. You can clearly see you don't need a big account to do this. So if the stock drops 20, 30, even 50%, most people end up panicking. But long-term investors see this as an opportunity to just lower the cost basis. So if my average right now is 82 and Hood goes down to 50, I'm able to buy it for those prices and average down my average costs. So now that stock doesn't need to make a new high, or at least it doesn't need to do it quick. It just needs to recover halfway or maybe 80%. It doesn't need to make that full recover. And you could turn a losing position into a manageable one. But again, you can only do this if the company is good and long-term has good fundamentals. Because if we go into a bear market, almost every stock's going to go down. If we go into a bull market, all stocks are going to go up. It's where we go on that sideways action when kind of the reality hits, and you see a lot of it in a bear market. You truly see what kind of companies their fundamentals are actually working. Now, there's another way you can actually benefit from a declining stock that you believe long-term, and that is selling options. And that's exactly what I do. So Mara, for example, I own 222 shares, but I'm actually able to make money even if the stock declines. Because when volatility rises or the stock drops, premiums end up rising. And the two strategies that I think matter the most, or that I use the most, is cash secured puts. So this makes money when the stock goes up, sideways, or even down slightly. Now, if the stock drops below your strike prices, you get assigned shares at a discount. You can see here I have a 13, 9, 10, $8 put, and I'm actually combining DCA or dollar cost averaging into this strategy with different expiration dates and different strike prices. And I'm okay with getting assigned at these prices. And that's why I want to go back to that first point where the stock selection is very important, and then also the strike selection is very important. So this is one of the few strategies where being wrong still gives you something useful. And it gives you shares you wanted anyways. Now, I don't know when Mara is going to bottom, how low it's going to go. I'm just simply saying that I'm okay with owning Mara at these price levels and getting paid to just wait to acquire these shares. And that's exactly what I'm doing. And I'm not buying Mara when it is in euphoric stages or just overhype or has hype momentum. Now, on the other hand, you could still make money. You could still make money when the stock finally gets momentum, and you could generate weekly or monthly income with covered calls. Now, I'm doing covered calls on pretty much all stocks that I own. I have it on HIMS, I do it on SoFi, Riot, and you could even do this if a stock is in the red. Now, it's a little bit more management, and you got to figure out what kind of strike price you want to choose, but it mostly works when the stock's going upwards, and covered calls actually help when the stock is going down. And they're not a massive hedge, but they are a hedge, and you can actually earn money when the stock declines. So, for example, something like Riot, I am down this past month, I'd say, pretty significant, down 35%, but my covered calls have been helping. I'm up $760, and that is income. I could use whatever I like with that income. And then when the market finally recovers, you can increase the strike prices, go out even further, and collect even more income. And you're sort of building that business type where you're reinvesting those premiums and reinvesting into bigger positions. You could put it you could do compounding and let it reinvest, or you could do another play or a different stock selection. You can really do whatever you want with those premiums. But you've built a pile of just realized premium that most investors don't even capture. They end up buying high and then selling low, or FOMO buying and panic selling. So the fourth point I want to mention is the long-term patience, because this is something that no one wants to hear. Everyone wants to get rich in 1 to 6 weeks, but the truth is declines are where long-term investors get their biggest edge. And that's because if you lowered your cost basis, you collect premium, you accumulate shares at a discount, your position for the next move or the next cycle is important. And you're not just waiting for the next candle. And this is why people bail out before they even see the recovery. And they end up just quitting before they even see some sort of reversal because they get frustrated that the stock keeps going down. So can you make money when a stock declines? And yes, you can if it's a good company and you use the right strategy. Of course, if you're using junk companies like Beyond Meat with junk fundamentals, it's going to be hard to find a strategy that's going to save you. So you want to make sure you have the good stock selection, your dollar cost averaging, maybe even selling options, and just overall having patience in that order. And when you combine these, you get the premium, you get accumulation, and you have long-term conviction. And you don't need a stock to moon to make money. You just need to survive the declines that everyone else panics during. And if you found this video helpful, drop a like and tell me below which stock are you managing through this recent decline. I'll see you in the next one. Peace.